Hi, thank you for your interest in my risk management and trading presentation. This presentation you'll find to be somewhat similar to the presentation I provided on Big Mike's trading regarding risk. So there'll be some of the similar topics discussed within this presentation. However, I have added a few sections that are new and will be very helpful in learning about risk management. So first, before I go into that, let's quickly go over the required risk disclosure, which is we do not provide financial or legal advice. The information contained within this presentation is for discussion purposes only. By continuing to participate in this discussion, you acknowledge that the information provided herein shall not be construed as investment and/or trading advice. It's recommended that each individual participant perform a self-assessment on the risk in which can be taken given their unique financial situation. Furthermore, futures trading involves substantial risk. You may lose all your principal investment or more. It's important to understand the risks associated with futures trading before doing so. It's also important to understand that any past performance of any type of market or trading analysis does not guarantee similar future results. Okay, so as I was saying, as I said before, the sections that are going to be covered here are somewhat similar to what you may have seen in the past with the risk presentation. However, I have added two sections in here, and that would be the dynamic position sizing and then trading for income versus taking a more professional approach using a fee-based professional investment management and the power of compounding your account growth. And of course, at the end of that, we'll just do a quick summary here. So, the first section is what is risk? Risk can be defined for this presentation within the following definition. It's really just the potential for an expected outcome to not reach its intended results. Very simple. So, what are the general types of risk associated with trading? Well, there's first of all financial risk, information risk, liquidity risk, performance risk, basis risk, technology risk, settlement risk, disaster risk, opportunity risk, credit risk, regulatory risk, counterparty risk, options risk, and event headline risk. So some of these I'll go into more detail, but just generally speaking, approaching the markets each day, we encounter these types of scenarios, and I'll go into those, more common risks that we face each day. So the first, risk specific to the intraday trader or retail trader at that. So we're just basically kind of summing these down is financial risk, technology risk, settlement risk, disaster risk, opportunity risk, event headline risk, and psychological risk. So I'll go into these a little more detailed and maybe potential ways of overcoming these risks that we encounter each day. So the first being financial risk. Trading losses are obviously a risk of just plain vanilla risk that we encounter each day with our trading, and that can lead to account depletion. And obviously that becomes, plays into the whole psychological aspect of it all as well. But that's certainly a risk that we need to develop some sort of way to manage, because it's there every day, and it will happen. You will take losses. If you don't take losses in trading, you're either the best trader in the history of the world, or you're not trading. So that's certainly part of your business plan that you need to have in place. Trading, and this again kind of goes in the psychological aspect of trading, and I'll talk to that in a minute here, but the need to make money for living expenses each trading day, that can lead to a major financial risk simply because you'll inherently make the wrong decisions. And the reason is you feel that you have to make money to pay the bills or whatever, and maybe you quit your job and you've decided to just only day trade, and that's going to provide you with income from the comfort of your own home or whatever. And it's absolutely possible, but again, it goes into the whole psychological aspect of it all. Also, financial risk could be simply being undercapitalized. Trading a market that's simply too big for your account size is obviously going to be a very difficult endeavor, and most likely will lead to making again those wrong decisions and maybe risking way too little for such a big market. And what I mean by that is you're simply being stopped out by noise rather than being stopped out in your trade for a meaningful reason. So maybe something structurally is broken down in the market and you stop yourself out versus having a few ticks stop, which is mechanical each trade you take, and just getting wicked out of your trades on each time. Of course, other aspects of financial risk would be margin calls, commissions and fees. You just really need to be on top of that type of stuff. If you're just intraday trading, margin calls may not be something of your concern, but if you're swing trading, obviously that's going to be a key factor in managing your business. Speaking of business, financial risk could also lead to high monthly overhead and really just a poor business structure in a whole. So, having, let's just say, a small account, maybe you're not really making much money, but for some reason you're using a platform that's very expensive, for example, or you're working with a broker that just isn't as competitive as far as commissions go, and they charge you fees or whatever. You really have to be on top of that kind of stuff. I mean, of course, this stuff's no-brainer information, but you'd be surprised with how people kind of forget about these simple little aspects of our business here. So having a high monthly overhead and really just a poor business structure, and what I mean by poor business structure is I guess it's more in the way of taxes, and I won't go into that too much here. It's not the right place, and as I said, I just don't provide tax advice or anything like that. But in essence, if you are structuring your business, and I'm referring to this in terms of how you title your accounts and the taxation of that, and how you distribute those assets, can make a big difference in what you're doing. So that's something for a later time, not today, but it's certainly a concern as far as financial risk goes. Technology risk, again, very, plain vanilla. We need to know this stuff going out of the gate anyway, but if you have a poor front-end trading environment, you're going to have a hard time. It's just I prefer to use, for example, I prefer to use trading, enter my trades through a depth of market price ladder. Compare that to, say, someone that just simply is trying to initiate trades through some sort of web-based application that is doesn't allow you to put your trades on real quickly or take them off, or visualize where your orders are sitting. That could be terrible. Another example would be simply a platform that is not stable and is constantly freezing up on you. I mean, could you imagine having a trade on and your platform freezes up on you, and all of a sudden now you're in big trouble because you can't get out of your trade? Slow internet connectivity, that's really just more to the idea of latency. Not as critical, but for the most part, it's the levels are the levels, but latency is certainly a concern. Inferior hardware, that's really just what I mean by that is just having a slow old computer or something like that just really can't process all the data that you're working with. Again, just that goes into the whole thing of freezing or computer crashing with a trade on. It's just really a dangerous scenario there. And then, of course, substandard knowledge of computers. It's kind of a no-brainer again, but I mean, you need to have some sort of understanding of how to operate your computer and work through certain things and make sure that your computer is up and running as it should be. Next type of risk a retail trader will face throughout each trading session is settlement risk, and that is has to do with slippage. So slippage really is if you want to, let's say you're trading crude oil and you've got a stop sitting at 100 even, and the market comes down there very quickly and liquidity is drying up and the market's crashing against you, obviously that the chances of getting your fill right at 100 even can be diminished simply because there's no liquidity there to match your order. So that's certainly a concern in your trading, and something that should be factored into any sort of risk that you take on in each trade. The next piece is broker errors, which doesn't happen too often, especially as technology continues to advance, but it's something that still happens from time to time, and it's good to be aware of that. And that, again, you really need to stay on top of what you're doing and review your end of the day account statement to make sure that your fills are matching what the broker statement's providing you. Just kind of, again, no-brainer stuff, but you'd be surprised how people often overlook these types of things. And that kind of, again, plays into the whole trade errors. And what I mean by that is this is not an error upon your broker doing, but simply a situation where you left an order sitting in the market or something like that, and you come back an hour later and see that you have a position on, and maybe you're up or down, whatever, but when that happens, it's best just to obviously close that position out and be done. Don't mess around. So I'll give you an example. I actually did leave an order sitting in the market. Just completely forgot. I was not using the OCO order. It was just an order sitting there, and completely forgot about it. And came back the next morning and saw that luckily I was up pretty nicely on the position, but it just, that could have easily gone the other way and been against me. So whenever that happens, it's best just to get out of that, and hopefully there was no bad damage that had happened there, but can be very scary. So you got to be really careful about that kind of stuff, and that's something that it's no fault of your broker. It's your fault. You got to stay on top of that kind of stuff. So be aware of that. Disaster risk. That's these are extreme occurrences, obviously, but it's still something to have some sort of game plan in place, because it can happen, obviously. So obviously a power outage, if you have a power outage, maybe make sure to have a backup battery for your computer, so to give you enough time to maybe get out of that trade if you have one on. Same goes with internet outage. What I do is, I use Interactive Brokers, so they actually have a phone app that actually has a DOM on it, and whenever that if that were ever to happen, it hasn't happened to me yet, but if that were to happen, at least I know I can close my position out on my phone. But obviously you can call your broker as well, and that's easy as well. But I just found that to be a pretty handy tool to have in place there. Computer issues, again, have some sort of a backup way to get out of your trade. As I mentioned, I use Interactive Brokers, but any broker out there, and I would highly recommend using someone that provides you with server-side orders. So if you're using an order cancel order, OCO order, and it's sitting on their server, and let's just say that your power went out, your internet went out, you had a trade on, or your computer froze up, at least you know that that order is still in place and is sitting on the server rather than your local computer, and you can rest assured that you're protected there. Erroneous orders, kind of what I talked about earlier, just not being aware of just having an order sitting in the market that you forgot about, and coming back and seeing that you have a trade on. That's obviously a scary scenario there. Trading loss, and what I mean by this is really just, as I have below here, the extreme emotional state, and those kind of work hand in hand as far as disaster goes, in that people can kind of go a little crazy with their emotions when they're having a losing day, and they aren't keeping their cool, I guess you could say, and just operating in an extreme emotional state, and just trying to impose their will on the market because they're upset about not the market not doing what they thought it would do. Obviously, we need to accept when we're wrong, but operating in that extreme state is going to lead to substantial trading losses. And one great example of that would simply be those that try to make their money back on the day. So let's say that you've taken a few trades and you've been wrong. All of a sudden you just can't believe that it's not working as you planned, and you're getting really upset, and you're pulling your hair out or whatever, and you're taking more and more risk on. That's very dangerous. So it's a huge disaster risk that can be more common for the retail trader. Okay, so opportunity risk. Really, all this, what I'm referring to here is missing a trade location. Let's say that you're off to the side doing something else, maybe chatting on the internet or reading emails or who knows what, and you're not paying attention to what's going on. That's a major opportunity loss there. And this is a business that requires just about 100% of your participation in watching what's going on in the market. You really can't get caught messing around. Sometimes there might be just one trade the whole day, so you got to be on top of that. Poor stop loss placement. Really, again, just kind of going to what I was talking about earlier as far as putting your stop at levels that just don't make any sense from a structural perspective, and just more of a mechanical, let's say 5-tick whatever. And what often happens is you end up getting stopped out at the high or low tick of that particular move or whatever. And the reason for that is you're putting your orders, your stop orders, at levels that just really don't define anything other than the fact that you simply just don't want to lose, or lose a certain amount of money. The market doesn't care about that. Again, distractions, as I just kind of alluded to earlier with the missing trade location. Emotional hesitation that kind of plays into the whole psychological aspect again. And what I mean by that is, the market comes to the level that you want to take a trade. You've planned on where to take this trade, and you just sit there frozen. That's a huge opportunity loss. I mean, you got to remember, the worst thing that can happen to you on a trade, any given trade, is that you get stopped out. That's it. It's not like someone's going to reach through the screen and choke you out. I mean, you got to overcome that small hurdle and really take what's yours, what you've planned on. So emotional hesitation can lead to a huge opportunity loss. Event headline risk, I mean, that's kind of a no-brainer as well, but really just having exposure to the market during key economic or political news announcements. One example of that would be, let's just say that you initiate a position right before the crude oil inventories report, or right before you put a position on in the ES right before the FOMC announcement. I mean, that there is just ignorance in that you're not paying attention to what's going on in the market, and will quickly lead to the bad outcome, to say the least. Sometimes you might get lucky, but you need to be very aware of those types of things. And then, of course, there's market exposure during unforeseen events or news announcements. So example would be the flash crash, or any other small flash crash that we've seen in some of the other markets, such as gold has recently seen something similar in that way. So if something like that were to happen, obviously your stop should be hit, but if for some reason the market were to skip over that or whatever, or you just you don't have a stop, obviously you just need to flatten your position out immediately. Do not try and hang on, because who knows how far the market could go. And then the last piece is just trading during the holiday sessions. Sometimes with the futures markets, the market will be open for a short period of time on a holiday session. So really not a good idea to try and trade on those types of days. Kind of no-brainer as well, but you'd be surprised. Okay, psychological risk. I referenced this a few times, but one of the biggest psychological risks is emotional trading. Emotional trading leads to impulsive behavior. It provides you with a poor perception and a poor decision-making process. And it's really just a whole part of the whole behavioral finance concept, where humans, when dealing with their own money, will inherently make the wrong decisions when using their emotion or an emotional response to that decision-making. So it's really very important to be aware of your emotions when you're trading, and the goal really is just to try and more or less operate like a computer. It just, otherwise you're going to always have a hard time with excuse me, navigating through your trading each day, because maybe you're trading while watching your profits and losses for the day, or you're scared of what the market's doing, or whatever the reason. These are not logical reasons to take a trade off. For example, you have to always work with logical reasoning when trading, which is so hard for many people, and it's probably one of the biggest reasons why people are not successful with trading is that they just can't get over that emotional aspect of it all. So huge risk, and certainly something to pay the most attention to. You can read every book that's out there regarding emotional trading or psychology, but ultimately it doesn't matter unless you really do figure out a way to handle that in real time. Otherwise it's all just theory. Okay, so that was it for that section. The next section here is measuring and managing risk. So risk management in and of itself should be a value-added edge in your trading. A lot of people seem to think that some sort of an indicator or whatever is an edge alone, and it simply isn't. Managing your risk is a big slice of that success, and it's very, very important to be aware of that. Risk in trading should be looked at from an unemotional perspective, as I just kind of went through. Each time risk is taken on, it should be clearly defined, and know that risk is not static. It's always changing based upon the market structure. And of course, it's best to use some form of insurance when taking on risk. And really, what I mean by that is simply using a stop order, whether it be a physical order in the market or some sort of a mental stop. Whatever works best for you. We can talk more about that some other time, but it's very important to have that in place. It's also helpful to actively manage your risk when you have a position on, which I'll talk to in a minute. So what's unemotional trading? So as I mentioned earlier, people will inherently experience an emotional response when dealing with their own money. It's important to trade with risk capital only. What I mean by risk capital is, let's say that you have, a certain amount of money, and you've decided that 20% of that capital you would like to use in more risk-like or speculative trading. And that's what I mean by that. So you certainly don't want to risk your life savings only on trading. That's just a very, very poor decision. With that being said, trading should not be a replacement for your ordinary income or your salary to pay the bills. And the reason for that, again, is just it changes the way that you view your trades. It brings in that whole emotional aspect that can cause major damage on your trading results. It's important to approach the market every day the same way. You just really have to develop a consistent routine of deciding what the market's doing when you sit down at your workstation in the morning, and figuring out what makes the most sense based upon what you've researched and where the market is opened, and deciphering what to do beyond that point. um, once you do have a trade on, you need to manage that based upon your research, not your P&L. So that's, again, the whole psychological aspect of it. Saying, well, I'm up a few $100s on this trade. That's great. I'm just going to close out. Who can argue with that? So what ends up happening is you end up taking these real small, profits on your trades, and then you'll have that one day that it wipes out everything, simply because you're wrong a few times. And what will that do to your confidence? It's going to crush you. So you have to obviously operate logically rather than emotionally, especially when dealing with your trade and looking. Don't look at your P&L if you don't have to. It's going to just mess you up. If anything, keep track of how many trades you're doing per day, how many you're right, wrong, or maybe have some sort of a limitation as far as max loss, whether it be number of trades or some sort of monetary amount. But don't just stare at it, your P&L there. It'll just make you emotional there. If the research and hypothesis is proven wrong for the day, react accordingly, or close down the trading for the day and just go reassess what went wrong. A great example is I pretty much have a kind of hard rule is if I'm wrong 3 trades in a row, and I'm not seeing the market correctly, and rather than inflicting more damage, it's probably best just to shut it down and then come back after the market closes and assess what went wrong and learn from it, and then just start fresh the next day. You don't need to destroy your account in one day. It's just, that's one of the things a lot of guys end up doing is they blow their account up. And why did they do that? Well, all the things I have listed here is emotional trading, looking at their P&L, and not having some sort of a max loss on the day, and that'll obviously lead to just major damage. Next thing you know, they're distraught and they're in an extreme emotional state. Speaking of P&L, I think it's important to judge your performance based on benchmarks rather than how much did you make per day or whatever. So what I mean by that is, and I'll go into this further in later sections in the performance management piece, but just to speak briefly, I like to use certain things such as the day's range versus what I got against the market. That's obviously short-term measurements, but I also like to look at how I've done on a longer term, say on a monthly, quarterly, semi-annual, and annual basis versus say whatever benchmark that's out there. And I'll, like I said, go into that further at a later time. But there are specific benchmarks I use, and I feel that that's a lot more of a logical way to look at my trading rather than saying, I have a specific monetary target that I want to reach each day. So let's just say I want to make $500 a contract each day. What the heck is that? Like, the market doesn't care about that. I mean, there's absolutely no way to know whether or not the market's going to give you that type of opportunity. So what I was speaking to as far as intraday goes is with the day's range is, the day, let's just say that the day only provided $300 a contract, and I was able to get a majority of that. Now that makes more sense. That's more logical. That's using a dynamic reference in what I'm basing my performance upon, rather than saying, I have to make $500 per contract a day. And if I don't, then I become emotionally upset and maybe I overtrade or whatever. That's very dangerous, and I think it's personally very naive to try and do that. So I mentioned earlier defining risk before taking a trade. Really important. Obviously, trading is not about how much you can make. It's about how much you can afford to lose on each trade. We can't control what the market does, but we can control our risk. And that kind of leads to the whole thinking process of timing your entries, obviously, and putting your stops at levels that clearly show you your trade is wrong, rather than it being, as I said, I can only risk, $50 a contract. That's the market, like I said, does not care about that. You really have to use that in the right way. Use your stops in the right way, which is, in my opinion, should be based upon structural references. Risk for a trade idea should be known before getting into a position. So again, just talking about that whole structural reference. And what that does, and I'll speak to this in the next section, is help you with your position sizing. So trade locations should be made from predetermined areas through your top-down technical analysis, and based upon your discretion of what the market's doing. So don't think that I'm saying I feel that buying crude oil at $100.50 is going to be my trade location for the day, and if it doesn't go there, I'm not going to even trade. That kind of goes into the whole opportunity loss there. Sure, maybe you'll be right, but what if you're wrong? So you've only got one trade on the day. It's better, I think, to do some analysis that's more of a larger aspect of what the market's doing and identifying that path of least resistance. If you haven't watched my top-down technical analysis presentation, I would highly recommend doing that. And the idea there is really just identifying that path of least resistance. And then once the day starts, obviously, we can take that information and build that into what the day is showing us in terms of what the market, where it opened, what's the structure of the market, what's the order flow, and go from there. Always use insurance in the event you're wrong through the use of a stop loss order. I've talked about that before, but a stop loss order should be placed at a location based on your analysis or trade idea that clearly shows that you're wrong in the trade. And if you're stopped out, it really means something. And if at all possible, try to not have your stop within the day's range or within the volume that is transacted on the day. Obviously it's very hard to do that, especially on some sort of a reversal trade or something like that. So obviously use your discretion there. But if your stop is sitting within the day's range, the likelihood of that being hit does increase. Of course, there are situations, as I said, of being reversals or whatever. But if the market has gone through that range at some point in the day, there is a chance for it to be revisited. Of course, the day type has something or a lot to do with that as well. But keep that in mind. Based on that location and analysis, the defined risk should then influence the position size relative to your risk capital, and I'll go into that here shortly. Let's move on now to managing risk while in a trade. So this is a different concept to what I've talked about earlier, but in addition to using insurance on a trade in the form of a stop loss order, we can actively manage our risk once in a trade through the use of multiple scale or target levels. This builds up a profit to protect our core position, and once scaled out, we can look to add to our core position again in an effort to scale right back out if there's a price discovery move or an imbalanced day occurring. Caution, do not use this on rotational inside days. And that'll be something again to be maybe walk through more in the trade methodology piece. But really, what I like, the way I term this process is a core satellite trading strategy, and it's not in the traditional sense. It's more in the sense of establishing a position, breaking it into units, which I'll go through here shortly, and trading around that core of your position. So let's just say, for example, you're just hypothetically just trading a flat three contracts. Each of those contracts represent one unit, and scaling out of two, with that remaining third being your core position that is more passively managed until your target expectation is reached. And while that's occurring, you can trade around that position with multiple scale in and outs on expansion, or not expansion, but price discovery days or imbalance days. And what I mean by that is the market's breaking out of the previous session's range. Another way to actively manage your risk is once the market breaks out of balance, or an expansion move. And what I mean by balance is just more or less the initial balance on the day. Trail your stop until price reaches your target area, or of course if the market comes back into balance. And this again will be discussed a lot further in the trade methodology piece. But essentially, there's two things I keep an eye on, so I won't leave you in suspense here. Is I track price as it reacts against the developing value on the day, and I also track the one-time framing behavior on the 30-minute TPOs, just to give you a brief insight of what I'm referring to there. And then lastly here, the original stop location you have in place, that should stay where it is until the market makes an expansion move. It's really important because if you, let's just say, for example, and I'll just give you a hypothetical one here, is you take a trade and you're one of those traders that do move their stop to break even once they get a scale out or something like that. The likelihood of the market coming back and revisiting your price level is often pretty high, especially if you're trading in markets that have a lot of pullbacks like the ES. So what will happen is that you'll end up spending a ton of money on commissions without any profits because you keep scratching your trades. So really the best thing to do is when the market establishes a balance on the first part of the day and then it breaks out of that balance, that means that obviously there's an imbalance in place, and we want to remain in our position so long as that market is imbalanced. And that's why that is when we really start to actively manage our core position and look to exit upon any sort of balance returning into the market. Very simple, straightforward, and like I said, I will talk to that in far more detail in the trade methodology piece that's coming soon, hopefully. But that is essentially what I'm referring to here. Okay, so that completes that section. The next section here is section 3, which is dynamic position sizing. And I think this will be new compared to the previous presentations I've done. And I think it's very important, especially if you're able to trade around I guess you could say full position size. For those that are just trading one or two contracts or whatever, obviously that won't be as timely for them or for you. But it's something certainly to work towards as your trading progresses. So position sizing should not be a static amount, and I say if applicable, which is if you can trade a full position size, and really a full position size would be 3 or more contracts, and this should be based on really just your account equity, or what I like to refer to it as is your net asset value or your NAV. And this helps with periods of drawdowns as well as periods of strong NAV growth. So what I mean by that is, let's say that you're experiencing a pretty strong period of drawdowns and you're just for some reason not doing very well and you're trading for let's say a week, month, or whatever. As your account or your NAV changes, you obviously need to adjust your position sizing accordingly. So let's compare the two just real quick here. Let's just say that you've got somebody that statically trades 8 contracts, and you have somebody that trades whatever their position size is based upon their NAV. So who do you think is going to end up getting annihilated quicker? It's pretty obvious that the person trading the static contract amount, and all of a sudden they'll put a trade on and they'll get an error saying that they don't have enough equity in their account to cover the margin requirement. So you really have to be dynamic as far as working with your position sizing. The position size should be a sliding scale based upon the risk required for the trade as well. For example, the higher the risk, the smaller the position size. The lower the risk, the larger the position size. This will also affect how many units the trade will consist of, and that's really just kind of based upon the day type. And there'll be some further explanation to that here shortly. By using a dynamic approach to sizing your position, you're putting risk at the forefront of each trade, rather than saying, you know what, I've got my DOM or whatever, my order entry system is locked on, again, that 8 contracts is only where the amount I put on each time, and I'm just going to keep doing that. So that's a very dangerous way of approaching your trading, and can lead to some substantial losses. So here's just a example of looking at an account size, and determining, based on risking 3% of your overall NAV while trading 3 contracts. This is simply an example. Use this at your own discretion, but this just gives you a suggested account size that you should be operating with, based upon those risk parameters. And again, 3% risk, and it's really just kind of average risk per market. Some of these may not be quite up to date, but that's the thinking here, is just more based on averages. So if we look here first, let's just start at the top with the NASDAQ. 4 points average risk. I don't know if that's really accurate. That's pretty tight stop there, but based on that amount, you'd need to have at least $12,000 to in your account to be trading 3 contracts there. With the S&P E-mini, 3 points average risk comes out to about $150 a contract. You should have roughly 22,500 in your account there. Again, these are just more round numbers based upon a 3% number there. Margin requirement, I don't know if that's still accurate or not, as they always change those amounts. The euro, kind of the same thing. Maybe maybe that's a little tight as well, but 15 ticks, $187.50 a contract risk. Need about $28,000 in your account to trade 3. And then the micros, which is was that a 1/10 of that amount there. Again, 15 ticks is $18.75. Need to have at least $2,800 to trade that 3 contracts there. Moving down to crude oil. Again, margin requirements, I'm not sure if that's up to date or not, but the average stop amount, let's say it's around 30 ticks or $300 a contract. To trade 3 of those contracts, you should probably have about $45,000 in your account. Again, that 3% risk amount. And if you didn't have that much, you wanted to trade the mini with 3 contracts, again, you're looking at about $187.50 per contract of risk there, with about $20,000. It's rounded up, but you'd probably need roughly of that amount in your account there. Again, this is just suggestions. You can certainly do what you want, but just to give you a sense of what I'm referring to here. Okay, so let's talk about position sizing here. And these are just examples. Since we talked about crude last, let's talk about crude oil here. And let's say these are 2 examples with the full-size contract on the top here and the mini on the bottom. So what this is really just a sliding scale that gives you a quick reference guide to how many contracts you can trade based upon the risk that the trade requires. So again, talking about that whole know what your risk is before you take your trade, here's a great example. So if we look at this table here, we can see that the average is around 30 ticks, and the account size here in this example is 100,000. And the top row is the 3% risk. Bottom row is 2%, or excuse me, middle row is 2%, and the bottom row is 1%. So if I feel that I only want to risk 2% of my overall NAV on my account, and the trade itself requires a risk of 30 ticks per contract, I'm going to only take 6 contracts on that trade. Whereas it's a very, very low risk on the trade, and I feel that I'm willing to risk 3% simply because of I'm very confident in the trade or whatever. And 20 tick risk per contract, I'm going to take 15 contracts on that trade. So you can see it's a very large sliding scale, and you can use these percentages obviously at your discretion. But if you're having a hard time in your trading, and for whatever reason you're dealing with some drawdown, and you're still, let's just say, at 100,000 or whatever, but the risk is 30 ticks per contract, or $300 a contract. You should only take 3 contracts on at that point. And anything above 35, 40, that's pretty extreme. So obviously you want to trade a lot smaller of a size on that. But let's just say that you're very confident in a trade, and for whatever reason you missed it, and the risk now increases because you want your stop to be placed at the right location still. So you obviously have to take a smaller position. So very straightforward. And then when we look at the mini, it's the same thought process. Obviously the ticks are going to be different because it's really half of what crude is, and they trade in different increments, $12.50 per tick rather than $10, or excuse me, well, it is $10 or 10 cents there per tick, like crude offers, full size I should say. But again, $10,000 account, and I want to trade risk 3% of my NAV. That's about $300 as a whole, and the trade itself requires 15 ticks of risk. Unfortunately, you can only trade 1 contract, and that's being very aggressive. You could actually, keep in mind these are rounded, so you obviously can't trade fractional contracts. So 1 contract for either 1 or 2, or excuse me, 2 or 3%. Will allow you to do that, but that's kind of the max. As far as you're only risking 2% there, you can only trade 1 contract there. But if the risk is beyond that amount, that's it. You can't even take the trade. It's just too expensive for you. Or unless you are willing to risk more of your account. So that's the thinking, is having some sort of a quick reference. Obviously, at some point you'll have this memorized, but it's helpful to establish some sort of quick reference in your trading decision making before the trade happens, so that you aren't caught, for lack of a better word, with your pants down on a big move that goes against you, and you're taking on way too much risk. You just don't want to get nailed. That's the whole important point I'm trying to make here, is you got to manage your risk first and foremost, and this helps with that. Position sizing and risk to reward. Let's quickly talk about that, because I haven't talked about risk reward yet. Risk reward is an important consideration to examine when taking a trade. This can play into the position size decision making process as well, as I've kind of walked through already. So for example, if the trade opportunity is somewhat limited, it's important to factor that into your trade, and as far as how are you willing to risk a big amount of money on a very small opportunity. It just doesn't make sense. An overall reward for the amount of risk being taken should be at least 2 to 1. And what I mean by overall is your total gain on the trade versus what was being risked. And then with your average gained per contract being at least 1 to 1, if not better. And you want to keep those odds in your favor, obviously, because as I said, there'll be times when you're wrong, and you don't want to take a loss that's way bigger than what you normally would make on a trade. So it's kind of silly. But that also, keep in mind that there's different ways to look at that, and use your own discretion. But I think that's the most reasonable there, if not anything beyond that. And I'll walk you through some examples here next. And then the last piece I'll speak to here is your trade's overall risk drastically changes as you remove risk throughout the trade. So actually, let me word that better. As you scale out of your position, the overall profile or risk profile of your trade will change dramatically. So I'll show you that in a second here. So first, let's look at this example. So we're still talking about position sizing and risk to reward. And what I've got here is just simply, these are based on trades that make the most sense. In this example, we had a market that was, gap down from several days of balance, and upon open, it was just, immediate initiative selling that pushed the market down very quickly. And let's say that, it pulled back to VWAP, and you felt that was a reasonable trade location. And really, in a scenario like that, when you've got this really strong selling tail, is and I'm referring to TPOs, which I don't have pictured here, but you just don't want to see that high being taken out. So there's your entry, there's your stop. So your stop is not in the market, your entry is at a key level there based upon what the market's doing, and that's how it all works out. So your stop is about 30 ticks away. Your trade target is really just unlimited. This is price discovery. It's the market's taking off and moving higher, or sorry, moving lower, and continuing to push lower. And really, actually, in this particular example, the market did come down to a very high time frame support level there, but you obviously need to be aware of that. But that's what we're seeing here. So the market came down to that support and bounced back and came back into value and just became rotational for the rest of the session there. But in this trade, the final outcome was 112 ticks gained for all three contracts. So this is just based on three contracts. The average was 37.33, average per contract. So this is kind of taken into consideration. Instead of just saying the overall gain, it's more of an average there. So you got to think of it in those terms as well. So what we can do then is saying, well, our overall risk to reward was 3.73 to 1, and I'm not adding, I'm not timesing 30 ticks by 3 here. It's really just an overall. So if you were to do that, it's these numbers would obviously be a lot different, but it would still be, it would still be positive, slightly over 1 to 1 there. And then our average, so we averaged 30 ticks was our risk average, and we averaged 3.73, so just slightly over that amount, so 1.24 to 1. And just it's just a diagram, but it gives you a sense of what we made on the trade here, and puts it into perspective as far as what's going on there. So in terms of position sizing based upon the opportunity, this would be probably something I would probably risk a lot on, simply because it's a breakout of the previous session's balance area. And when we see those types of opportunities, they're usually pretty big. And I would have probably taken a bigger position size in something like this. Okay, so contrary to that, we have a rotational type trading session. This was actually the day before that sell-off, that gap down sell-off day. This is a day that's very rotational. It's trading within, you can hardly see the previous range here, but that's the ledges of the previous profile. But it's a day where the market was very rotational. It looked above, came right back into range. At this point, we know it's very rotational. There's no breakout, there's no price discovery. Our trades need to be targeted. So here's a setup where the market came down to the developing value low. There was clear absorption. Obviously I don't have that picture in this chart here, but there was clear absorption there. And it's a good rotational or destination type trade. So there was a swing high. It's covered with this text here, but there was a swing high here, and there were shorts that got in on this. But I could see, and I don't have this pictured here as well, unfortunately, but and this is something, again, I'll go much deeper into in the trade methodology piece, but the cumulative delta really did not drop at all with this drop. So we went from the value high to the value low here, but delta really didn't drop much at all. And so that's a great long setup there, and it's just a destination trade from one extreme to the other on the day, and with our stop being below the previous session's point of control there. So a 20 tick stop, and the target was 40 ticks. That's not a big opportunity. So when you see something like this, does it make sense to really risk a lot of your capital on something like that? And the answer is no. I mean, at least in my opinion, it's not the best idea. So I would position size smaller, and I would have my targets at smaller levels. So the first level is actually the previous swing high or just above it. I know there's stops sitting up there. I know I can get a quick fill on my target there. And then the next level is at just above the previous days, or excuse me, the intraday high or the IB high there. So stop there, and of course, as soon as it got up there, stops were cleared out of both levels, and that inventory is taken out of the market, and the market just kind of just drifts back down into range. So you don't want to risk a lot on these types of trades, and you don't want to sit there thinking that the market's going to take off in a breakout move. And if it does, there's always a chance to get back in, but it's very rare based upon what was happening that type of day. So the final outcome on a trade like this is a total of 70 ticks for the 2 units. Really, in this example, I'm just saying 2 contracts, just to keep it simple. And the average is 35 ticks a contract. So that gives us an overall risk reward of 3.5 to 1, with an average of 1 3/4 to 1. So, is it a great trade? Yeah, I mean, 70 ticks. I mean, if you're trading 2 contracts, $700 made on the trade, that's still a nice return. Even though the opportunity was fairly limited, you didn't risk too much. So that's the way of thinking there, is being dynamic and using your discretion on your trading size, rather than always sticking with the same size. Because if let's say I risked the same amount as I risked on the previous trade, and the opportunity is very low, but it's a very low opportunity day in that, and I risked so much and it went against me and stopped me out, the chances of having other trades that could develop that day that might make up for that or whatever. And not to say that I'm trying to do any revenge trading or anything or encouraging that, but it would simply, your opportunity is very limited to make that back. And again, not the best way to think about that, but keep that in mind, put it that way. Okay, so now that we've kind of walked through position sizing and risk to reward and things like that, it would be a good idea to discuss the classic debate of scaling versus no scaling. I think it's an important one because I think a lot of people have a lot of different opinions about it, and I feel that I'll walk you through it, but obviously I feel it's more important to scale out of your position and actively manage your risk versus just sitting there. So what do we get when we actively manage our risk? Well, scaling out of a position immediately removes position risk and changes the overall risk profile of the trade. So as I mentioned before, that the risk changes as you're scaling out. Let's just say that you're only risking, you're trading 3 contracts and you're risking 20 ticks, and your first scale out gives you 10 tick scale out, or 15 ticks, as you say, 15 ticks. So now you've captured 15 ticks, and your risk is dramatically changed. So that's very different than, say, if you are holding that full risk on still. What if the market comes back and stops you out on the rest? Obviously, the one that you scaled out, you're not going to lose as much. The one that you held the full position on still, you're risking 100% of your initial trade. So it's really that in my opinion is enough alone to tell me that makes more sense. Scaling out of your position provides flexibility in the event that the final target is not reached, and you're capturing profits along the way. So you're working a position and cycling through profits and protecting your core. Whereas no scaling provides really just 100% risk the whole time, unless your trade is hit, or if you have some sort of stop trailing type method or something like that. Obviously that would change things as well, but I think it's a lot more reasonable to take advantage of those price opportunities as they're happening in the event that the market comes down to or up to a level and immediately turns around. At least you've captured some of that. So let's look at a diagram. This might be a little blurry as far as the text goes. I apologize for that. But this is the same diagram I have on the Private Banker Forum. And what this is scaling, a diagram of scaling versus no scaling. And it's just walking you through the difference between what one may have made in terms of scaling out the differences of what they would receive if the final target is hit and not hit. So the top one, scenario one, all targets are hit. Of course, the one that you held the full position on is going to make more money. Let's just hypothetically say that these point levels are structurally placed there. So this one you don't take anything off, and then the final target's hit. Unfortunately I didn't put that there on that amount there, but essentially it's $1,500 was right there as well. But whereas this one you're peeling risk off as the trade is going in your favor. So we ended up with $1,100 versus $1,500. Okay, so a $400 risk, a $400 difference on the trade, but the whole time the guy on the right was probably sweating when the guy on the left was building confidence in the trade as it was going in their favor and as they peeled risk off. So you can sit back and relax once you got your second scale out, obviously. The next scenario is we actually had two targets reached, but the final target never got reached. So we get stopped out of the remaining part. The first one, again, we captured 200 on the first scale, 400 on the second, and we got stopped out for 300 on the last piece there. Contrary to that, if we look at the no scale outs, there was no profit was captured, and the market came back and stopped that trader out for a full stop out. So that's the difference between walking away with $300 in your pocket or taking a full loss. The next scenario is we only got one target filled. So 200 and then stopped out on the rest. No fill, full stop out. So again, a big difference, a $500 difference. Losing 400 here while I'm losing 900 there. I think that's pretty clear there. And of course, a full stop out's a full stop out. There's no advantage there. I mean, there are ways to manage that as well. When you see that the trade's not really necessarily working in your favor, that's something very advanced and something maybe to discuss down the road. But right now we can see just from a pure binary perspective that equal outcome there. So we can see though, when looking back at this scenario, there's a lot of green here, but a lot of red here. So what would you rather be, the guy that sweats through his trade the whole way, or one that is sitting back in your chair by the second scale out and relaxing with your feet up on the desk, if that. I think it's a smarter way of managing risk, in my opinion. So I talked about it briefly earlier, but I mentioned the term unit size, and unit size is probably maybe something you're familiar with, maybe not, but essentially it's the amount in which you decide to divide your position up in. So each unit will have a specific amount of contracts within it. And what this is, it kind of plays into the whole creativity and discretion of trading. I fully feel that trading is an equal art form and science, and I would almost lean towards a bit more on the art side, simply because that's just kind of the way I think, I guess. But I think that using creativity and discretion based upon what the market is showing you can make a world of difference in what you're doing. So an example here, let's just say that the overall position size is 6 contracts, and we divide that up into 3 units, and this provides you with 3 target levels with typically 2 contracts per unit, and the underlying amounts can of course be customized to your preference, but I think just for round numbers, let's leave it at 2. You could your scale outs would be at 2 contracts each level. You can also, in another example, let's just say you're trading 4 contracts, but the opportunity is really limited, like I pointed to in that previous example, just a kind of a rotational type of day. You can establish 2 units, and with 2 contracts within each unit, or you could, divide it up however you see fit. But I think that's another way of looking at it. And then, of course, on a really strong imbalance type day, with an unlimited target, you really don't know how far the market can run. And let's say that we're working with those 6 contracts again. Your units can be broken into 4 units, or whatever amount you see fit. And again, this will be more into the trade methodology piece. But when the market is really starting to exceed its weekly average true range, that's really a heads up for me to start really taking advantage of those that deviation of price expansion there, and book some profits at those extremes, because you never know, the market could quickly correct from that point. So you can divide your units into how many you want at that point, and of course that has a lot to do with how many contracts you're trading as well. But it's a powerful enhancement to what you're doing. So this approach allows you to use your discretion on each trade opportunity, allowing you to adapt to the ever-changing market conditions that we always see. We just really cannot predict how far the market will run, but we can use different tools and methods to take advantage of those opportunities. And contrary to that, mechanical targets simply don't provide that same type of flexibility. And I really think it's naive, especially in an imbalanced scenario. And of course, it is retail oriented, and I don't mean that to speak above the retail world or anything like that, because I am part of that now as well to a degree. And it's I've been on the buy side, institutional side, for my whole career, and it's a different way of thinking, obviously, but I think it's very powerful to remain dynamic versus mechanical. So that was it for that section. Let's go into the last section here that has content, and then we'll move into the last piece. Is really just the summary. But I'm just going to go over this quickly. And this, again, this is at your discretion. I'm providing this as more or less an example of what I feel makes the most sense. I mean, obviously people can operate in either side of this discussion and make valid points, but I'm just doing this more or less as what I feel is the most logical and reasonable. So trading for income versus fee-based professional investment management. And what I mean by fee-based professional investment management is not saying to formally start a hedge fund or anything like that, but to approach it similar in that way. So let's talk about trading for income first. So the general assumption within the retail world is that it's the best and easiest way to utilize your trading profits. You can trade from the comfort of your own home in your pajamas. The thought, what I'm saying there is let's say that at the end of the month or end of the week or whatever, you made $5,000. You take that full amount out. So that what this is doing is I say it ignores the concept of asset allocation and risk management, and I'll kind of talk to that a little bit more. So I'll just leave it at that for now, but it really does ignore that important aspect of what we're doing here. You may be asking yourself how. I don't understand that, and I'll explain that shortly. But what this does is, when you're taking all your profits out, it encourages traders to use that money to pay for their living expenses, of course, or to be very dumb with their money and go out and blow it on things like going and buying a Ferrari or something like that. I mean, trust me, I love cars, I love Ferraris, I love Porsches, but I don't take my monthly profits out just to go out and blow it on a car. It's a lot bigger picture there that needs to be taken into consideration. The problem with that type of thinking also is that it removes the opportunity for compounding NAV growth. So that compounding growth is so important, and I'll show you an example of that here shortly. One thing to note, and I'll go into this next, is all professional traders earn a salary. This removes the whole psychological risk, or that whole scare of certainly you can be scared as a professional trader, obviously, but I think what I'm alluding to here is trading for income brings in the emotions that you have to pay the bills for what you do, and that, as I've gone over multiple times here, that just brings in the wrong type of thinking. It's all emotional. Whereas a professional trader earning a salary, they're thinking logically, they're approaching the market from a logical perspective. They aren't sitting there feeling that they absolutely have to make money that particular day. So it's a very different way of looking at the market. Retail traders can earn a salary from their trading if approached correctly, and I'll show you that here shortly. So fee-based professional investment management is, what it does is it takes asset allocation and risk management as a top priority. Trading serves as more of a hedge activity rather than for income, and it's really just a smaller part of a grander concept of managing assets. Professional traders, as I said, earn a salary, which removes the whole behavioral finance hurdles, and they really put the NAV growth as a high priority, which means profits are reinvested within the overall target asset allocation model. Obviously they do earn a salary, and it depends on how we define professional traders, of course, and I'll walk you through that. But it's a very different way of thinking. So this is a professional investment management approach where 80 to 90% of what they're doing is more or less long-term investment management, and then the intraday trading, or the hedging, if you will, it takes up a very small percentage of time and capital. So this would represent time and capital, this whole pie chart here. But hopefully that helps you with understanding how these higher time frame traders are looking at the market. So how can retail traders earn a salary? Well, first of all, professional traders, hedge funds in this example, charge a fee for managing assets. They also charge a performance-based fee, which is typically a percentage of the overall portfolio's gains. The industry standard is 2%, an asset management fee of 2%, with a 20% performance incentive fee. So many of these managers reinvest those performance fees within the portfolio, but of course they have the discretion to take that out if they want to. But the idea there is, by reinvesting that money, it really helps to grow that NAV, and of course a larger NAV provides them with the higher net asset. The higher NAV provides them with higher asset management fees. So again, that goes into the whole thinking of building a salary rather than trying to take a chunk of change out of what you're doing each time you make money. Retail traders can adopt this variation. They can look to charge their account an asset management fee, and of course a performance-based fee. They can withdraw the asset management fee on a monthly or quarterly basis, whatever makes the most sense. And of course the performance-based fee could be their bonus that they either take out or reinvest however they see fit on, say it's on a quarterly or semi or annual basis. And this obviously promotes compounding NAV growth while still being paid for your hard work. And again, use your discretion when thinking about doing this, but it's a very logical way of approaching your trading and using it more as a business rather than a means to try and gamble to make money or whatever. So here's an example of how a retail trader could potentially structure a business like this. And keep in mind, this is not making big bucks or anything, but the idea is over the long haul to accumulate substantial assets so that you can reinvest those assets in more passive type investments, which that's another conversation entirely. But let's just go through this example quickly here. So we've got an NAV of $100,000. We decide to charge the account 2% on a quarterly basis. So that fee amounts to $2,000. That's annually, keep in mind. I mean, you can obviously change that to however you see fit, but this, just for simplicity in this example, let's just say that 2% is the annual fee, and it obviously will fluctuate with the NAV, but you can charge it on a quarterly basis, and it's obviously not a lot of money, but again, this is just an example. Let's also say that account grows by 20% for that year. So net of our asset management fee and plus our 20% gain, our NAV is now at $117,600, and our incentive fee comes to $3,920. So again, not big bucks or anything like that, but it's money to either be taken out or if you'd like, just to reinvest that money, however you see fit. But let's just assume that we took the money out, so that leaves us with an NAV of $113,680. Well, even though we took money out, we still, our new asset management fee has increased by a whopping $273. But you see the point here is that as the NAV grows, so does your asset management fee. So again, this is keep in mind these are just small numbers, but as I said before, you should not be trying to be trading for income, because it changes the whole dynamics of what you're doing. But at least approaching it in this way, and whatever percentage you ultimately decide to do, at least you are seeing some of the fruits of your labor here. And of course, as I said, as your account grows, so does your fee income, and as you start to make more and more money, you can redirect those assets to more passive investments. So let's just hypothetically say that you feel that at a maximum you never want your trading account to be over $500,000, and all the money you're making from that point on is being reinvested into passive investments, and you're growing that pool of assets, and you'll start to get income off of those assets rather than worrying about income off of managing the trading account. So there's so many different ways that you can structure this, but I think you get my point in that you can approach this from a professional perspective and still see, as I said, the fruits of your labor here. And the goal is to achieve substantial NAV growth, which will provide your capital to be reinvested in longer-term passive investments, as I've been talking about. Once that's achieved, the dynamics of your income stream will change to the following. So, here's our daily trading. Those short-term trading profits are then reinvested into longer-term, more passive investments, and we can manage that on a daily, weekly, monthly, or however you see fit perspective. And then the income ultimately that you'll be receiving, and this isn't like some get-rich-quick scheme or any silly thing like that. This is just trying to outline what it would look like once you get to that level. And so you'll be getting your fees from your managing of these assets, and you can also charge a fee on this, of course, or this pot. So fees, as well as any sort of passive income you get out of this, and to whatever you see fit, of course. So it provides you with a very diverse income stream, and it completely, well, I won't say completely, but it drastically removes the whole emotional aspect of trading. So let's now just go over, as I was talking about, how we can see the difference between compounding NAV growth versus taking a fixed amount of money out of our account each month. So the column on our left here is we're taking a fixed income out of our trading account, and the column on the right is we're simply leaving all of our profits in there to further grow and obviously help us build larger position sizing and whatnot. So The account, this is again just real hypothetical basic stuff, starting with a $50,000 trading stake here, and the first month we make 3%, which equates to $1,500. We're net even there. I should rephrase that actually. I said 1,000 fixed amount. I should say if the account makes 1,000 or more, take that out. Or if I don't make, in this column, $1,000, I still take that amount out. That's probably a better way to put it there. So anyway, back to where we were. So we made $1,500 in this column as well as this one. This column we took out that $1,500. This one we didn't. So the next month our starting account balance is $50,000 versus $5,100, or excuse me, $5,100. Excuse me, I can't talk. $51,500. Excuse me. And then for that month we actually have a bad month and we lose 5% of our account. So that's $2,500 lost on this side, $2,575 lost on this side. So that brings our starting account balance down, obviously. In addition to that, we also take $1,000 out for income in this column. So starting in the next month, we've got $46,500 to start here, with $48,925 to start here. And maybe we're a little shaken up this month, and we only make 1% back on our trading here. So $465 gained on the month. Nothing to write home about. But again, we have to take our $1,000 income here, whereas this, there's no reason to do that. Just continue to grow our NAV. So next month we start out with $45,965 versus $49,390. And we're feeling pretty good. Last month it wasn't the best, but it wasn't the worst. We made money, and we make 4% on our trading here. So that's $1,838.60 that we made. And on this side it was $1,975.60. So on this side we're saying, oh great, I actually made the amount I needed to make to take out for the month, and I can even leave $800 in there. That's great. Now it's working. Whereas this, we left it in there and reinvested that money. So start the next month, we're starting with more money. It's $46,800. We're feeling great here. And on this side, we actually have more. We've now gone above our initial investment amount, not quite above the full amount of here we go again, $51,500, but pretty close at $51,365. So we're doing good. Maybe we got a little too confident this month and we lost 5%. And again, on this side, you got to take your fixed income out, $1,000. The overall loss before even taking money out was $2,300 and change, whereas here we lost $2,500. So it definitely hurts to lose 5% of your account in 1 month, but it does happen. So we start the next month out at $43,463 on this side, and we're down to $48,792.32 on this side. So still pretty close to what we put in it here, whereas this, we're really starting to lose our investment here. It's really being drawn down pretty significant. So for whatever reason we do okay, and we make 2% on the month. And again, we take our fixed income out, so we take all of what we made in the month and then some on this side, whereas on this side we took out nothing. It just reinvested that $975. So good stuff there. And now at the end of 6 months we can see how we did. So on the left side, at the end of 6 months, we have $43,332.69 versus $49,773.27. So big drawdown. We're down 13%, whereas this side we're down marginally, barely anything, not even a percent there. So we didn't take any income here, but we took $6,500 out of our account here. So we can see that essentially we're flat, but we're down 13% in this account simply because we had to take that fixed income out each month. So let's see how we do the next 6 months. All right, so the next month, obviously starting the same amount, we make 3% on the month, so 1,200, almost 1,300 bucks on this side, whereas this side we make almost 1,500. So we're starting to see the change in return on that compounding growth there. So again, you know, this may be a typo here, but I don't. For some reason, I think I left that in there, but I think it's just 1,000 out. Yeah, it is just 1,000 actually. So we took 1,000 out. Sorry for that typo there. Hopefully my math is correct here. And then on this side, we don't take anything out. We made $1,500. Start of the next month, we're at nice gain in the month. So we're up a little, 43,632 versus we're now back above our initial investment amount again here, 51,266. And this month we do really well. We make 5%, and that's $2,100, almost $2,200 here. And now we're really starting to see a pull away here. We're at 2,500 here, so really nice increase in gains here, and that takes us up to a new high, count mark there. Whereas this, we're still well below our initial investment. So we took our $1,000 out. We're now at 44,800 and change versus 53,800. And this month, essentially kind of flat, but we lose 1%. Not a big amount of money, 400 here, 500 there. But again, we got to take our $1,000 fixed income out, whereas nothing here. I mean, you can obviously see where this is leading to, but I'll keep going. Now we're starting with less than we had before by pretty fair amount, and but this month we make 4%. We make what we need to take out again. We can leave $700 in there. 4% here. Now we're well over $2,100 on the month in earnings. That's pretty nice, and we're moving up as far as our growth goes in the NAV. So this month we took our 1,000. Now we've got 44,000. We started with more than what we had last time, but this time we made a new high amount on our account. We're up 55,000 and change. So you can see, I'll just quickly go through the last bit here, but 2%, $800 didn't make what we needed to make, so we're going to end up with less. Whereas this here, we made $1,100 and change, and we finished out the month and really just year at the high point. So still below what we put in, 44,000, whereas here we're up to 58,000. Income taken for these 6 months was 6,500. So again, this is a typo. Actually, no, I've included that there, so maybe it isn't. I apologize for the math not being precise there, but essentially you get my point here is that the account here, it did have a modest growth of around 2%, but look at the comparison here with this account. It made 17% growth with an overall 1-year return of, so we're still down around 11%, whereas this account here we're up well over 16%. So not a bad year on this side, but you can see the power of compounding growth, and that's the idea there. And of course, you could figure out, well, if I made, I'm still roughly where I started at, but I was also able to take out, around $14,000 for income for the year. If that's what suits you, then that's certainly fine as well. I mean, the returns are the same. You can just see how the overall returns can drastically increase, and over time, the idea here is this account on this side is going to get bigger a lot quicker, and we can start to redistribute that capital, as I was alluding to earlier, into more passive investments. Okay, so that pretty much is it for that. Let's just go through a quick summary here. This presentation should have provided you with the following: a new understanding of the various risks associated with trading, ways to reduce risk from a general perspective down to intricate trading concepts, and also provide you with a way to approach your overall trading from a more professional perspective. So really important to understand these concepts and not get caught up in all the common pitfalls that can occur in trading. So anyway, if you have any questions about any of this in this presentation, I've got a Q&A section on the Private Banker forum. in the risk management section. And I would highly encourage you to join this forum if you haven't done so already. But if you are a member, feel free to ask any questions that you may have. And again, if you're not a member, the Private Banker Forum is really just a place for like-minded traders to share ideas and thoughts on the markets, all centered around auction market theory, and just provide your best thinking forward in a very professional environment, and a place where people like to look at equal terms and share ideas and whatnot, and it's not a place for trying to compare who's the best trader or who has the best ideas or anything like that. It's very, very professional in that sense. So if you haven't joined, please check us out at the address here, and hope to see you soon, and thank you for watching this presentation, and hopefully it's helpful for you, and I'll talk to you soon. Thank you.